things as a financial analyst you would be doing is valuing an equity, valuing a bond, valuing a derivative, valuing any kind of instrument, and based on that creating portfolio. That's a typical job profile of majority of the financial analysts. So from that standpoint, inside the equity, let's look at the valuation aspect, where we are just introducing to the concept of valuation in level 1, but as we move along we would be in the next level. There is a lot of calculation aspects around the valuations of the equity securities. So whenever we use the word in this valuation, we always use a very common word called overvalued versus undervalued. See, in most of the cases there is a market price for every asset which we think of in the world. There is a market price and there is a price which we perceive or which we feel is appropriate for that particular asset. Probably for an air conditioner there is a market price, and at the same time, based on the features or based on something, we create our own assessment of a price. So our own assessment is always called as the intrinsic value of the asset. So at any point in time, we will compare the intrinsic value of the asset, which is our assessment price of the asset, versus the market price. So wherever we are seeing that the market price is lesser than our assessment price or the intrinsic value, we say that that particular security is undervalued. Because our assessment is, oh, we are saying that even this much price is okay for it. But in the market, it is available for much cheaper than that. So we may say that that particular asset is undervalued, and probably we can go for a buy decision on that particular asset. Whereas whenever we are talking about the market price greater than the intrinsic value, then we are calling it as overpriced and better not buy or probably sell off the asset. So that is where we talked about, we use the word called mispricing. So any valuation we are trying to do, there are multiple ways. Probably it could be out of our perception, or it could be a standardized way of, or it could be some formula based way of deciding your value. So there are hundreds of methods which can be used to decide the value of a security, but the whole intention is to understand which of the securities are mispriced, means our intrinsic value different from the market value. And so typically we have to see that today that security should be mispriced. Only then I will get into a misprice, means difference between our intrinsic value and the market value. So between these two, today if there is a kind of a difference, we will think of getting into a buy or a sell decision with an intention to bridge the gap. The prime intention is, okay, today this is our intrinsic value and this is the market price. So market price is cheaper. So what will we do? We get into a buy decision. Undervalued, so we get into a buy decision. So because of a lot of people like us thinking like this, there is a huge buy decision that is happening, which will actually increase the price. So after some period, it may so happen that the intrinsic value meets more or less the market value. That gap actually gets reduced. That is the prime intention of valuation, and then doing your decision making of buy or sell based on the valuation. Right? So it could so happen, if there is a lot of demand for a security, probably the top 50 equity securities or top 100 equity securities listed on BSE or NSE, there will be a lot of volume which is traded on them. So those kind of securities, it's very difficult to find them undervalued or overvalued for a longer period, because people will quickly take their buy sell decisions and try to avoid that gap to a large extent. Whereas other securities, which are very small in size and all, you find that there will be a lot of mispricings available on those securities. So if you start doing your in-depth research on those small securities, which probably you may think of getting a very good advantage investing in those kind of securities, because most of the analysts neglect those small securities. So there is a chance of finding a lot of a gap between the intrinsic value and the market value for those securities. Then whenever we talk about equity valuation models, there are three major categories to focus on. Probably we can categorize them as DCF models, discounted cash flow models. So the concept of that we have dealt to some extent in quant, where we have used the concepts like NPV and IRR, and even in case of capital budgeting, where again we have used a discounted cash flow model to evaluate a capital project. So DCF is a very general kind of class of models which are used even for valuing your equity securities also. Apart from that, you have multiplier based models or multiple based models. So we use some kind of ratios like P by E ratio, P by price to book value ratio. We have seen some of the valuation ratios as a part of financial statement analysis chapter in FRA. So in that we were using some kind of multi-valuation ratios which were falling into these categories, and there we have also said that if those numbers are very high, then it is treated as overvalued, otherwise it is undervalued. So that's the second category of model. And the third ones we are talking of asset-based valuation. So assets, I'm just finding out the value of the various assets the company is having, the machines, the inventories, the investments, various assets which the company is having, finding out the market values of each of the assets, and then doing a kind of removing the liabilities to arrive at what is the final value of that particular company. So looking at these, the DCF, as the word itself is saying, if you remember the way we have done the NPV or IRR analysis, we are talking about the present value of the future cash flows. And in an equity investment, what are the future cash flows? Today I invest, the only thing I get is the dividend. Let's say I buy a share of a company, the only thing I get is the dividend, and probably if I sell off the share, the capital appreciation. One of these or two of these are the maximum amounts in the future I'm going to get out of the investment in this particular share. So that is what we are talking about, discounting these to the present value. So forecast the dividend or forecast the share price after a couple of years and discount them to the present value, and based on that find out the intrinsic value of the share. Or sometimes if the dividend patterns of the company are ad hoc, we can also resort to the free cash flow based valuation models. We have defined the free cash flow in our cash flow chapter, the amount that is available with the company which is comfortable for distribution to the equity investors after all the payments and liabilities have been paid off. Whatever is the cash that is available with the company which can be distributed to the equity investors. So that is, so instead of dividend, people will estimate what could be the FCFE for the future and use that FCFE and discount it to the present value to arrive at the intrinsic value of the firm. And when it comes to multiple based models, we have already discussed P by E, P by BV, P by sales, P by book value, or nowadays even people are using enterprise value by EBITDA. We'll talk about the enterprise value and all. So these are the various kind of formulas that are being used on a ratio comparison basis, right? So P by E, I'll compare company X P by E with company Y P by E. If P by E is higher, I may say that that company is overvalued compared to company B. So such kind of valuation models can be derived. And finally, the asset base. So we are simply looking at the total value of the assets minus the liabilities, and then find it out on a per share kind of a basis, which is what is an asset based valuation model, generally applied for